It's Thursday, December 8th. You're watching the Daily Market Comment by Mario Sajikiriakos. I'm Christina Marujos, and thank you for joining us at XM.com. Investors have started to play defense. There's a distinct sense that the main threat next year will be slow or negative economic growth, replacing inflation as public enemy number one. This has induced a quiet flight to safety in financial markets. The bond market has been at the epicenter of this shift. A sharp decline in Treasury yields and a deepening inversion across the yield curve suggest that recession risks have started to overshadow inflation in the eyes of investors. Yields are essentially the price of money, so any sudden moves can have powerful domino effects in other assets. In this case, the slide in yields dealt a blow to the US dollar, but it also breathed life back into gold. Gold has started to shine once more, capitalizing on a perfect storm of falling yields, the pullback in the dollar, China's central bank raising its reserves, and speculation among top strategists that Russia might start selling its oil in exchange for gold. The wild card is what happens with inflation and the Fed next week, but looking into next year, there's scope for a comeback in bullion as growth risks dominate and central banks conclude their tightening cycles. Dr. Crude has given an ominous diagnosis of the world economy, with the latest breakdown in oil prices signaling deteriorating prospects for demand. Crude prices have now erased the entire rally of this year and are trading lower. In the equity arena, the major indices on Wall Street retreated, albeit not much. The decline in yields reflexively helped to blunt the impact of the broader rush to safety, limiting the losses. Even so, the risk-to-reward profile for equities is not attractive here. Valuations are still expensive by historical standards, as the S&P 500 is trading above 17 times next year's estimated earnings, which are themselves vulnerable to negative revisions based on what leading indicators suggest about the global economy's fortunes. The rejection from the year-long downtrend line in the S&P 500 might have signified the end of this relief rally. Over in Canada, the central bank raised interest rates by 50 basis points yesterday, exceeding market expectations. The loonie spiked higher in response, but surrendered its gains fairly quickly to trade lower as investors placed greater emphasis on the signal that this rate hike might have been the finale in this cycle. Sliding oil prices played their role too, helping to push the currency lower. Elsewhere, Chinese authorities continue to relax COVID control measures, injecting some optimism into local markets, with equities in Hong Kong gaining more than 3%. This was a Daily Market Comment here at XM.com.